What is securitization and why did it fail in 2000? Imagine turning a bunch of loans into a product you can buy and sell easily. That's what securitization is all about. It's a way for banks and lenders to transform loans like mortgages or car loans into securities that can be traded in financial markets. This process helps lenders get cash quickly so they can make more loans, and investors get new options to earn returns. The process starts when a bank issues loans to borrowers. These loans are then pooled together into a special entity called a special purpose vehicle. This vehicle isolates the loans from the bank's other assets, making it easier to sell the securities without risking the bank's main funds. The pooled loans are divided into different layers called tranches. Each tranche has a different level of risk and potential reward. The safest tranches get paid first, while the riskier ones get paid later, or only if there's enough cash flow. Once the tranches are created, they are sold to investors. To make these securities more appealing, financial institutions often add protections called credit enhancements. These can include extra collateral, reserve accounts, or prioritizing payments so investors feel safer. This system allowed banks to transfer the risk of default to investors and free up capital to make more loans. It also created a whole new market for fixed-income investments, giving investors more choices. But in 2008, this system fell apart. The main reason was the quality of the loans backing these securities. Many of these loans, especially subprime mortgages, were given to borrowers who couldn't really afford them. These risky loans were bundled into securities and sold to investors who didn't fully understand the risks involved. The complexity of these products, especially collateralized debt obligations, made it hard for investors and even rating agencies to see how risky they really were. Rating agencies often gave high ratings to these securities, even when they were built on shaky loans. They had conflicts of interest because they were paid by the same companies issuing the securities. Loan originators also had incentives to give out as many loans as possible, regardless of whether borrowers could pay them back. When housing prices fell, many borrowers defaulted at once, causing losses to cascade through all the layers of securities. Investors, many of whom borrowed money to buy these securities, faced huge losses. As the value of mortgage-backed securities plummeted, banks and financial institutions suffered massive hits to their balance sheets. This led to a credit crunch, where lending froze up, and the entire financial system was shaken. The crisis spread globally, causing a recession that affected millions of people. In short, securitization was meant to spread risk and improve liquidity, but poor loan quality, lack of transparency, and flawed risk assessment turned it into a recipe for disaster. The failure prompted new rules and regulations to make markets safer and prevent a repeat of such a collapse.